Hello! In this video, I would like to talk about how the market works. But this will be purely my opinion. No smart money, no blocks, liquidity, and certainly no candlestick formations and structure. I'm gonna be like a troublemaker now. Ooh, and bring some doubts into your business. Just to make it more interesting, I won't be whining, but I'll get straight to the point. Any market consists of three components: price, time, and volume. That's it. There is nothing more. The price on the financial market is what costs the most after freedom, love, and of course, good food. Joking aside, market price is a monetary valuation of assets such as stocks, bonds, commodities, or currencies. It can be represented as a number or a graph over time. The value of an asset depends on various factors such as supply and demand, economic and political situations, competition, and other factors that can fluctuate significantly. Time on the market is the interval during which an asset changes its price. Time is the same for everyone, but everyone has their own time interval, so the variety of time frames significantly reduces trading opportunities and analysis. It seems to be the opposite, but it is not. It is precisely because of the connection between price and time that the chart looks like an endless Russian nesting doll, where analyzing one chart often will not be compatible with another. But this is our reality, and there is no escaping it. The market volume is essentially the amount of money that is transferred from one pocket to another within a specific period of time. The amount of traded volume itself does not indicate any market forces. However, if price, time, and volume are combined into one entity, it is possible to draw accurate conclusions. In every family, there's a black sheep, which means someone among them wants to sabotage us. We can clearly see the price and determine the time, but the volume always wants to remain in the shadows. When we see volume in a specific candlestick, we have no information about who bought and who sold. Essentially, we trade in markets with three variables where one variable is unknown. Depending on the volume that enters the market over a certain interval of time, the price of an asset will shift. The higher the volume over a short period of time and the lower the liquidity at a particular price range, the stronger the price movement will occur. The price moves not due to the number of buyers or sellers. If there are more buyers, the price goes up, and if there are more sellers, the price goes down. This is incorrect. The number of buyers and sellers is always equal. If a buyer cannot find a seller, a transaction will not occur. The market order drives the price. If the number of market orders in the bid on the exchange exceeds the number of limit offers, and the number of market orders in the sell does not exceed the limit demand, then the price will rise. A simpler concept of growth or decline is the aggressiveness of the first or second, which is precisely understood as market orders. Well, you could assume that the glass is already empty and one lot will move the price, but go ahead and try to find any asset now, where anyone who enters the market isn't immediately backed by a market maker. That's it. The farce is over. The order book will be filled. That's pretty much the entire mechanics of it. Now, as for the highs and lows and why prices move from one to the other throughout the existence of financial markets. You may think I'm going to talk about the liquidity that accumulates around the high and low, but I'm not. In smart money, there is a concept called interbank price delivery algorithm. In fact, this is a system used by banks to evaluate the prices of financial instruments. So there is a system, which is a certain standard, and all participants in this market are connected to it. When one bank decided to buy currency, it made a request to another bank, which approved it, and due to the demand, the price of the instrument went up. This system takes into account price changes, and by outputting the average, transmits data to all other participants. Essentially, this is synchronization. According to the smart money system, chart extremes are identified as liquidity zones. These are where traders' stop orders accumulate everywhere and serve as fuel for the market. This is what is referred to as an interbank algorithm. I call such places activity zones. I'm not an advocate for the idea that the market is controlled, but I also don't deny the presence of market manipulations. Yes, such zones have served as liquidity for position accumulation in the past, and will continue to do so, but not everywhere. If you examine the chart over its entire history and find that the price movement remains consistent, it implies that the market is not being manipulated. All the turning points in the market act as magnets, not because traders follow technical analysis, but due to psychology. Greed and fear govern the market. Greed is a cunning force that entices traders to take higher risks and grow their deposits. This emotion lurks deep within our psyche, breaking all bounds of reason and transforming into a true monster. This nuisance can take hold of a trader's soul in a matter of seconds and stoke the flames until disaster strikes. Fear arises when a trader encounters an unexpected price change. It makes us hesitate and doubt our decisions, blocking any further actions. Very often, fear prevails over reason and logic. These two brothers, greed and fear, are indeed the reasons behind market stops and reversals. It's precisely because of the emotions of the crowd, which are often similar, that people with money and algorithms build their positions. There's no need to manipulate the market in such cases. Let's take this moment. In this small range, buyers and sellers were making transactions, and the longer this range persists, the higher the volume there. When the price breaks out of this range, some traders start to profit, triggering the greed skill in them, while those incurring losses may experience fear. When will the price stop? There are several reasons, and they all converge at roughly the same point. First, stop-loss orders enter the market, followed by those who were hesitant to enter immediately and were waiting for a move, as well as those gripped by greed and afraid of missing out on the movement. These three fools push the price. At first, profitable traders driven by greed hold their positions until the very end. However, when the fear of a price reversal sets in, they start closing their trades. These are the first ones who begin to slow down the market. Right away, you have the knife catchers, enthusiasts who believe the market has had enough and it's time for a reversal. At the same time, the nervous ones start realizing losses, those who prefer not to use stop losses. Additionally, on the sidelines, there are traders waiting for the price to drop further for a subsequent purchase. Indeed, due to all this market turmoil, when some become more aggressive than others, the price starts to stall. In principle, for the same reason, a new movement begins, and so it goes again and again, over and over. That's clear. But what about those moments when the price keeps hitting the same reversal points? Because these are areas of activity, meaning the places where the highest trading volume starts to occur, and where the majority of traders become active. Besides those who trade with technical analysis, breakout or bounce strategies, or use smart money techniques, emotional actions once again predominate. What? Again? Overcoming greed and fear is much more challenging than sticking to your strategy. Any strategy explaining how the market works is essentially a collection of historical coincidences that, with positive mathematical expectations, can lead your deposit to profit. First of all, at old highs and lows, either profit-taking occurs, for those who entered the trade before the movement began, closing a break-even trade, for those who entered the trade earlier at the same price, opening a trade, for those who are hoping for a repeat of history, cutting losses, for those who entered the trade in the wrong direction, opening a trade, for those who are hoping for a continuation of the movement. In these zones of activity, only two actions take place: closing a trade and opening a trade. And these two actions are once again based on the same psychological crutches: greed and fear. When the price is between these zones, traders are not interested. That's why there's little liquidity there, and the price often moves faster than usual. Moreover, such imbalanced movements don't always arise from the influx of large capital. It's simply the dominance of one emotion over another. According to statistics provided by major brokers, it seems that people trade in a roughly 50-50 manner, with half selling and half buying. However, there are times when one side dominates with statistics as high as 80%. Let's take a look at a simple example based on a trader using smart money. Here's an order block. In this case, the trader entered a trade, placed a stop behind the block, and set a take profit at the nearest liquidity. When the price doesn't reach the take profit and starts to reverse, the trader experiences the fear of incurring a loss and moves their stop loss to break even. This order becomes the foundation for a breakout in price movement. It turns out that once again, emotion comes into play at the level of the old extreme. The same thing happens with the take profit. Pretty interesting, isn't it? We ourselves influence what happens in this zone of activity, and depending on the majority of our actions, large players make decisions. As for filling the imbalance, it's all much simpler. Imbalanced movements primarily occur due to a lack of liquidity, not because a particular fluid market maker is involved, but because the majority are waiting for the price in the zone of activity. The predominance of certain factors for stopping sudden movement also determines their price and reversal. Moreover, in imbalanced movements there is no volume, no trading, and therefore no liquidity. The absence of liquidity always attracts manipulators, making it very easy to bring the price back into the imbalance zone. Players' decisions based on their emotions explain why all support and resistance lines seem to be either broken, rejected, falsely breached, or not reached at all. But who can know in advance what will be in their minds? In advance, no way. But these decisions are visible in the moment. So, what's the bottom line with manipulations? They exist. Large capital has minimal latency and sophisticated algorithms that provide signals to trading robots. A slight distinction occurs when there is an order for a specific volume at a specific price. That's when a consolidation phase begins, and the volume is accumulated precisely through these swings. However, it's not blind stop orders that are being accumulated, but rather the signs of the predominance of the desired orders in these active zones. These signs indicate in the moment when it's time to enter and when to wait. What's the conclusion? The market doesn't manipulate as some might claim. All financial markets operate based on the presence of large orders that can only be executed in active zones. Nobody pre-draws the chart in advance. Manipulations occur only at specific moments and only when there is liquidity available,